You've seen the headlines. Nvidia, a $5 trillion behemoth, the Magnificent 10, now worth more than the entire economies of Japan, Germany, and the UK combined. Artificial intelligence is not just the future, it's the booming, thundering present. A revolution that promises to cure disease, solve climate change, and usher in an age of unprecedented abundance. Or does it? What if I told you this isn't a boom? What if I told you it's a bomb? A ticking time bomb planted right at the heart of the US economy, and its fuse is getting shorter every single day. You think you know about bubbles? You remember the dot-com crash? You saw what happened in 2008. You're telling yourself, this is just another cycle. I'll ride the wave, and I'll get out before it pops. You are wrong, fatally wrong, because what's happening right now is not the dot-com bubble on steroids. It is something new, something far more dangerous. It's a bubble built not on flimsy websites and bad business plans, but on concrete, steel, and trillions of dollars of real physical infrastructure. And when it bursts, it won't just wipe out a few tech stocks. It has the potential to trigger a deep, painful, and prolonged economic collapse that will make 2008 look like a minor correction. Today, we're going to pull back the curtain. We're going to expose the $4 trillion lie that Wall Street is selling you. We're going to listen to the stark warnings from one of the most respected financial minds on the planet, a man they called the Dean of Valuation. And we're going to show you why this AI bubble isn't just a threat to your portfolio, it's a threat to your job, your savings, and the very stability of the American economy. This is the story they don't want you to hear. This is the real economic danger of the AI bubble. Part 1. The Grand Illusion. To understand the danger, you first have to understand the illusion. The story we're being told is a powerful one. We're told that companies like Nvidia, Microsoft, Meta, and Alphabet are building the foundational architecture for a new world. They are spending hundreds of billions of dollars on chips, on data centers, on computing power. This spending, this capital expenditure, is so massive that it's single-handedly propping up our economic growth figures. It's the engine behind the jobs reports, the reason the stock market hits new highs, the source of the relentless optimism you hear on financial news every single day. The conventional wisdom, even among the skeptics, is that yes, we are in a bubble. Bill Gates says it. Michael Burry, the man who predicted the 2008 crash, is betting against it. Even fashion magazines are writing articles about the AI bubble bursting. But listen closely to how they talk about it. They treat it like a market event. A necessary correction, a feature, not a bug, of major technological change. And that's where the deception begins. Because they're asking the wrong question. Professor Aswath Damodaran of NYU's Stern School of Business is arguably the world's foremost expert on corporate valuation. He's not a promo bear. He's not a doomsday prepper. He's a man of numbers, logic, and cold, hard analysis. And when he was asked about the AI bubble, his response was chilling in its simplicity. He said, "Let's stipulate it's a bubble. So what? Why all this hand-wringing? Don't misunderstand him. He's not being dismissive. He's pointing out that everyone is so focused on the label, 'Is it a bubble?' that they are completely, utterly blind to the real danger lurking beneath the surface. They're arguing about whether the ship is hitting an iceberg, while completely ignoring the fact that the ship's engine is actually a massive bomb. The real danger isn't that Nvidia's stock might fall 50%. The real danger is what that fall would represent. It would represent the end of the single largest capital expenditure boom in modern history, and that is the trigger for the collapse. The conversation about stock prices is a parlor game, a distraction from the structural rot that is setting in at the very foundation of the American economy. While Wall Street obsesses over price-to-earnings ratios, the real economy is being hollowed out and replaced with a fragile dependency on a single, speculative technology. This isn't just a financial bubble, it's an economic dependency crisis waiting to happen. The public is being led to believe this is about investing in the future, when in reality, it's about subsidizing a grand experiment with the nation's economic stability. Part 2, the $4 trillion lie. Let's talk about the math. The dirty, inconvenient math that Wall Street analysts and tech CEOs don't want you to do. Professor Damodaran has done it for us, and the numbers are staggering. Right now, big tech is pouring hundreds of billions of dollars, soon to be trillions, into building the AI infrastructure. They are building colossal data centers in the middle of deserts, consuming more electricity than entire countries. They are buying up every single high-end chip that Nvidia and its competitors can produce. This is real money, hard cash being spent on physical goods. This is called capital expenditure, or CAPEX. Now, in a sane world, an investment of this magnitude would need to generate a return. You don't spend $1 trillion unless you expect to make more than $1 trillion back. So, Professor Damodaran ran the numbers. Given the amount of money already spent and committed, he calculated that the AI products and services market, the actual things that AI will do for us, needs to generate $4 trillion. Let me repeat that. $4 trillion in new revenue or in costs saved. $4 trillion. That's the size of the entire German economy. And right now, how much is the AI products and services market generating? It's in the tens of billions. It's a rounding error. It's a drop of water in the desert. This is the $4 trillion lie. The lie is that we will somehow, magically, close this gap. That out of thin air, we will create new products, new services, new industries, so revolutionary that they can generate trillions of dollars in profit almost overnight. But look around you. As venture capitalist and author Scott Galloway points out, where are these products? Do you see AI-inspired cars from GM? AI-formulated moisturizers from L'Oreal? No. What you do see is the other side of that equation, cost savings. But cost savings is just a polite corporate term for something much uglier, layoffs. Companies are saying, we're using AI to cut our legal fees, which means firing lawyers. We're using AI to automate customer service, which means firing call center employees. We're using AI to write code, which means firing software developers. The only tangible return on investment we've seen from this multi-trillion-dollar bet so far is the elimination of human jobs. So here's the terrifying equation. To justify the current valuations to even begin to close that $4 trillion gap, we will need to see economic disruption and job loss on a scale that makes the Industrial Revolution look quaint. We're talking about a potential chaotic unwinding of the labor market in industries across the board. Or, the valuations are a lie. The whole thing is a fantasy. And when the market wakes up to that fact, the correction won't be a correction. It will be a cataclysm. As Galloway puts it, one of two things has to happen in the next 12 months. Either we see utter chaos in the labor markets, or the Magnificent Seven get cut in half. There is no third option. This binary choice represents the precipice on which the economy is teetering. Either the human cost becomes astronomical to justify the investment, or the investment itself is revealed as a colossal misallocation of capital, leading to a financial implosion. The entire narrative of a smooth transition to an AI-powered future is a dangerous fiction. Part 3. The dot-com deception. Why this time is different. This sounds exactly like the dot-com bubble. We had crazy valuations, companies with no revenue, and a big crash. The market fell, but the economy was fine. We got Amazon and Google out of it. We survived. We'll survive this. This is the most dangerous assumption you can make, and it is completely fundamentally wrong. Listen to Professor Damodaran again, because this is the single most important point of this entire video. He states unequivocally that the infrastructure spending during the dot-com bubble was a fraction of the infrastructure spending that has gone into the AI phenomenon. Let me break down what that means. In 1999, the infrastructure was mostly software, websites, and a few server farms. The investment was largely digital. A company could go bankrupt, its website would disappear, and the real-world economic impact was relatively contained. It was a stock market event, not a Main Street crisis. Today is different. The AI infrastructure is brutally, massively physical. It's hundreds of billions of dollars flowing directly into the real economy. It's construction jobs building the data centers. It's manufacturing jobs making the chips. It's logistics jobs shipping the hardware. It's energy sector jobs building the power grids to run it all. Right now, a huge portion of the US economy's growth is just this AI CAPEX cycle. It's Microsoft paying Nvidia for chips. It's Meta paying construction companies to build data centers. It's Amazon paying power companies for electricity. This spending creates a powerful illusion of a healthy, growing economy, but it's a house of cards. It's a circular economy of hype. And here's the terrifying truth that Professor Damodaran laid bare. If you take away that AI CAPEX spending, the US economy has effectively been in a recession for the last year. The growth isn't real. It's an artifact of the bubble itself. So what happens when the bubble pops? What happens when investors finally realize that the $4 trillion payday is never coming? What happens when the Sam Altmans of the world can no longer raise tens of billions from delusional people with deep pockets, as Damodaran calls them? The spending stops, the construction projects halt, the chip orders are canceled, the demand for electricity plummets, and the foundation of the so-called strong economy crumbles overnight. Unlike the dot-com bust, this won't be a fire contained to Silicon Valley. This will be a shockwave that rips through the industrial heartland, through the energy sector, through logistics and manufacturing. It will be a full-blown economic crisis, revealing the recession that was hiding in plain sight all along. This isn't just about tech workers losing their jobs. It's about construction workers, electricians, truck drivers, and factory workers across the country suddenly finding their projects canceled and their jobs obsolete because the fire hose of speculative capital has been turned off. The contagion will spread from Wall Street to Main Street with unprecedented speed because, for the first time, the bubble is directly financing a huge chunk of our physical economy. Part 4. The Catalyst Conundrum and the Ponzi Scheme. So, if it's all a house of cards, what's the one thing that will make it fall? What's the catalyst? This is where the story gets even more insidious. With past bubbles, the catalyst was often clear. In 2008, it was Lehman Brothers collapsing. In 2000, it was a wave of dot-coms running out of cash. But with AI, Professor Damodaran warns the catalyst will be fuzzy. There won't be a single day of reckoning. It will be a slow, creeping realization, a death by 1,000 cuts. And that makes it even more dangerous because it allows for complacency. It lets the bubble inflate to even more terrifying proportions before it finally gives way. But we are seeing signs. We are seeing the cracks form in the dam. Look no further than OpenAI, the poster child of the AI revolution. Recently, on a podcast, its CEO Sam Altman was asked a very simple, very fair business question. How can a company with its revenues make commitments to spend over $1 trillion? His response was not a business plan. It was not a strategic vision. It was pure, unadulterated defensiveness. "We're doing well more revenue than that," he snapped before offering to buy the interviewer's shares. As Professor Damodaran noted, there's no business argument in there. You have a man who has been handed the keys to a multi-trillion-dollar vision, and when asked how the basic business works, his answer is essentially, if you don't like it, leave. This isn't the confidence of a visionary. This is the panic of a man who knows the numbers don't add up, and it gets worse. Look at how these companies are investing. It's become a tangled, incestuous web. Microsoft invests in OpenAI. Nvidia invests in dozens of smaller AI startups. Those startups then use that money to buy chips from Nvidia. Amazon invests in Anthropic. Anthropic then commits to spending billions on Amazon's cloud services. As Damodaran points out, this looks less like a healthy competitive ecosystem and more like a Ponzi scheme. The big players are investing in each other, propping up each other's valuations, creating the illusion of a booming market to lure in the rest of the world's capital. They have to keep the music playing because they know that the moment it stops, the entire charade collapses. This incestuous cross-investment tells you one thing. Deep down, they lack true confidence. They are hedging their bets, creating a cartel to prevent anyone new from breaking in, and praying that the market doesn't notice that the emperor has no clothes. This circular flow of money isn't creating real value. It's simply relabeling investment capital as revenue for other players in the same game. It's an accounting trick on a global scale, designed to sustain valuations that have become completely detached from any underlying economic reality. The moment one of these major players decides to stop the music, or an external shock forces them to, the entire self-referential system will implode. Part 5. The Contagion. Why there is nowhere to hide. Okay, so the bubble is real, and its collapse will be devastating for the tech sector and the real economy that depends on its spending. But savvy investors might think they can hide. They own industrials, consumer staples, international stocks. They think they can weather the storm. They are wrong. Professor Damodaran issued his most dire warning on this very topic. He said that in today's market there is no place to hide. 20 years ago, if U.S. tech stocks were overvalued, you could move your money to European stocks or Japanese stocks, or even to safer sectors like utilities. That doesn't work anymore. Thanks to globalization and the rise of massive, passive index funds, the correlations across all asset classes have risen to the point where everything moves together. When the panic starts, it will be a stampede for the exits, and everything will get trampled. When the Magnificent 10, which now make up an insane 40% of the S&P 500, go down, they won't go down alone. They will drag the other 490 companies in the index down with them. The panic will not distinguish between a high-flying AI stock and a century-old railroad company. All stocks will fall. Your 401k, your retirement account, is not insulated from this. The very structure of modern investing, designed for efficiency through index funds, has become a transmission mechanism for systemic risk. What's the proof? Look at the canary in the coal mine, gold. Gold is hitting all-time highs. This is highly unusual. Typically, gold soars during a crisis, when markets are collapsing or during periods of hyperinflation. But right now, on the surface, stocks are booming and inflation is supposedly under control. So why is gold rocketing upwards? Because, as Damodaran explains, the smartest money in the world is getting scared. People who would normally invest in stocks and bonds are so terrified of a bubble, not just in AI, but across all financial assets, that they are fleeing to the one thing they can trust, a physical asset that has held its value for 5,000 years. People like hedge fund billionaire Ray Dalio are now major advocates for holding gold. Think about that. A man who made his fortune navigating complex financial markets is now advocating for an inert metal. It's because he sees the systemic risk. He sees how fragile the entire system has become and how difficult it has become to find a safe place to put your money. The gold market is screaming a warning. It's telling you that a massive correction is coming. The question is, are you listening? The message from the gold market is one of profound distrust in the paper assets that underpin the global economy. It suggests that a subset of the world's most sophisticated investors believes a crisis is not just possible, but probable, and that the traditional havens within the financial system will not be safe. This isn't just diversification, it's a flight from the system itself. Conclusion, the final warning. We stand at a precipice. The world is mesmerized by the promise of artificial intelligence, blind to the catastrophic economic danger it has created. We have an industry built on a $4 trillion lie, a gap between hype and reality so vast that it can only be closed by either mass unemployment or a market collapse. We have an economy whose growth is a mirage, an illusion created by the unsustainable capex spending of the bubble itself, a bubble whose pop will reveal a recession that was already here. We have a financial system so interconnected and correlated that when the tech behemoths fall, they will drag everything and everyone down with them, offering no place to hide. And we have the smartest minds in finance, the Deans of Valuation, signaling profound fear through their analysis and their embrace of non-financial assets, screaming a warning that almost no one seems to be hearing. The AI bubble is not just another tech story. It is the economic story of our time. It's a story of delusion, of greed, and of a system-wide vulnerability that we are ignoring at our own peril. The question is not if this bubble will burst. The only question is when, and what will be left of our economy and your savings when it does.